If you come across lots of great deals and you have friends with access to lots of money, you're going to want to hear what Devin has to say.
Ryan's talking about friends like doctors, lawyers, and the stock market's giving them, 8%, but they just can't get anything above that. You could offer something to them that would benefit them while also being able to take down more of your own deals and earning more from each of those, because you're not just letting them go, right? You're helping those along the way. And so we compare this to, some of the biggest funds in the world like Bridgewater and Citadel. We compare it to what Grant Cardone has going on with a crowdsourced fund. And specifically, the best way to start, though, would be a fund for a specific deal that you already have in the works. And so you could see the potential there, and you could bring it down to what's currently going on the ground with you today. So I know you guys are going to love this one. Yeah, you were on in December. Mm-hmm. And certainly enjoyed having you there. And so give us an update since then. Have you closed any deals?
I would be a pretty bad business person if I didn't close any deals in that timeline. And so I'm thankful, man. Yeah, we've been able to close deals, which is great. We've been able to kind of grow the company, but also made a massive pivot into a couple things. And then even I can tell you a little bit of a private pivot that I took personally. And so, yes, we've learned, just to kind of give a little more context. Back then, we were doing a lot of foreclosures. I think we talked a lot about foreclosures, which is great. So we still do the foreclosures. One of the things we do now is we just do a lot of subject to seller finance things. And then we've gotten to a point where we actually sell those on seller finance notes. So we're wrapping them, which is crazy because it gives us a really good down payment, monthly income, but no more real estate. Because I've kind of gotten to the point where I'm like, ooh, rentals, not my cup of tea. And everything, there's different strokes for different folks. And so our company primarily does that now, which is great. So we do the foreclosure. So we still wholesale. We don't flip anymore. And then we do seller finance notes. And then I mostly focus now on, I think back then I was just starting it, but where I help people to launch and scale investment funds, raise capital, and started a software for that. So super crazy year, a lot of pivoting, but going deeper in the main things, kind of keeping the main things. Before we were a mile wide and an inch deep, and not anymore now. So I'm thankful for that.
Got it. So before you were doing wholesales, buy and hold rentals, flips. That's what you mean by doing a mile wide. You're just doing lots of different exit strategies.
Yep.
And so now you're still wholesaling, but you're not flipping and you're not doing rentals.
Nope.
And what are the seller finance, wraps? How do you tell me about that type of deal?
Yeah. And this is really great. So what I've been doing is being hey, if you've got deals, so really it's grown pretty good because we use a lot of, I get a lot of deals from wholesalers now. But it's been a way to be able to take deals that have no equity or low equity and still be able to make something out of them. For instance, I always tell people too, if you in Charlotte specifically between July 2021, maybe August 2021 to now, prices of houses have not outpaced the cost of fees and commissions. So, right, in the beginning of 2022, prices dropped 8 to 10%, depending on where you are, probably more. But since then, they've only risen 1 to 2% each. And fees and commissions are at 9%. So we're seeing a lot of houses, new builds, houses that were sold or flipped in the last 4 years and sold, sitting on the market for 100 plus days, and they don't have much equity. So then what we do is we come in, we negotiate subject to, right? We negotiate creative terms with them, get the property under contract in a subject to situation. And a lot of times people will do this because their house has been sitting on the market. We pay the realtor commission. So realtors are great, this is good. And then we transition that to, we get it under contract, and then we'll take it and we work a lot with people who are, so I also in the time created the Zillow for seller finance notes. So we put all of our houses on this platform. And on this platform, we have a buyer's list of people who are not very bankable, but have cash. So a lot of these are going to be entrepreneurs with no W-2 income, but they make money because they're good entrepreneurs. Or a lot of this is immigrants. So people from other countries, a lot of Hispanic people that work very, very hard, but not very bankable, don't have bank accounts. And a lot of construction workers have just $50,000, $100,000 in safes in their house because they don't put it into a bank. Mm-hmm. And so then they come in, they want a property, they'll put down a down payment on a property of ours. They'll put down a down payment, and then we have a seller finance note with them. So we pay our underlying mortgage that we got subject to, And then we typically have the delta between the two, right? So like if we're, just for example, we had a house we just did this on last week, and the underlying mortgage was $1,700. The new mortgage that we set up with that person was $2,100, and they did a $50,000 down payment.
Whoa.
And so we got 50 grand right off the top. And then now we make 500 a month, and we just hold the note. No more tenants, trash, toilets, none of that stuff. And so, and then so there's like it's almost like a triple net, right? So we get the down payment, we get the monthly income. And then if he goes in the next 9 years, this is like, we calculate like 7 to 9 years. In the next 9 years, if they refinance us or sell us out, they'll pay us an additional like 30 to 40 grand because we've paid down our note, and our amortization schedule is more just beneficial than theirs is, or just like helps us out a little bit more. And so over time, that gap widens again. And so then we get paid at the end of the 8 or 9 years as well. So the profit on that house ends up being like 130 grand over 9 years. So
Wow.
It's crazy. And yeah, so that's kind of what we're doing now.
So in where you're located, the important part of that is that what is the foreclosure process, right?
Yep, that's right. So in North Carolina, where we are, we do these in North and South Carolina. Typically, there's like a 3 months. You get the list pendants if you're out for 3 months, and then you're assigned a trustee. The bank, like you can assign a trustee. It's going to be a local foreclosure attorney in the area, a Hutchins, a Brock and Scott, a Logs, whatever. You pay about $2,500, and then they kind of do the process for you. And then, of course, there's legal fees in that come from the actual foreclosure. But that's like the process of the the price of the process is like $2,500 minus the fees.
Okay, got it. Yeah, and 3 months is not terrible. Some places it's a year plus, right? So that would be tough to do this type of business model there. So,
that's right.
Great.
That's right. And so we've kind of transitioned into that, and that's been cool. We've liked that because now I have people like I've partnered with really good wholesalers, like Hayden down in I think, and it's Quality Home Buyers down in Charleston. They'll send me like 6 a week because they're houses that they don't have equity. Their people don't have equity in. They talk to them, they prep it to us, and then we pay them a fee, and it works out pretty well. I'm thankful for that. So
Nice.
Yeah, that's fantastic. So where can people send you those deals, right? If they have a seller who needs to sell but doesn't have a lot of equity.
It's true. I actually just I literally just put, so I've been vibe coding like everything lately. So if I have spreadsheets, I just turn it into a vibe coding like app and website. So I guess I send the link in here, and I should probably make a short link to this. But if you go to so I created it's called ProperRight. It's like a property analysis software, but properright.com / and I think it's /sub quick submit. And I'll send you the link and you can put it in there. And then like people can create an account. We keep them updated on like everything the house is doing, so they know all along the process, and they can quickly just submit properties in there. Maybe I'll make a shorter one and you can put it in the notes. I probably will do that. I'll buy like a shorter domain. And so,
Nice.
yeah, and then we can send that. That'd be easier.
Okay, perfect. So, man, and then is that the software you were talking about, or what was the software you said?
Oh, good. So, no, this is probably going to be the thing that I spend the next like 10 years building, but it's called Fund Flow. One of the things that I've really loved to do is help people to launch it. So I partnered with my SEC attorney, and we help people literally if they want to launch a fund. You want to launch a real estate fund, you want to launch a private equity fund, VC, whatever. We help you to structure it, figure it out. It's kind of like a community. And then we actually would do your docs for you and help you to launch it. And so a lot of people were like, hey, do you have like a portal or a way for me to manage my investors and to do this? And I was like, no, but let me build one. So I built one, I vibe coded one, and then eventually brought in a technical founder because, as you guys know, vibe coding can only get you so far. And then it really just starts to suck, honestly. And so had some technical people come and join me to actually build it out. And then now we're building out what we say is like the smartest operating system for managing investors and raising capital for real estate professionals. So really like a lot of all that. And then we have these things called micro funds. So like, let's say you want to do a syndication. Typically it costs like 10 to 20 grand to do it, but, and it takes like 2 months. Now we have it to where like $6,500, less than 7 days, we get your docs done and approved by an SEC attorney. So like we tried to build all that stuff in there, and that's what I'm doing now. So that's cool. So there's the real estate side of it. Still have that company because I've got great leadership there. Amazing, amazing people and team. But I've kind of personally pivoted a little bit more over here. And so I'm thankful to have both right now.
So who would be starting a fund? Who typically starts a fund? A wholesaler that wants to go do something, complementary, or who would actually be starting the fund?
I love this. This is a fantastic question. So if you've got a lot of deals, you may want to start a fund, but like specifically, so there's 3 different people in a fund. There's the operator, the capital raiser, and the fund manager. All 3 of those are pretty essential, and you probably should have all 3 of those because they'll make your life easier. And in the fund space, more like good people is better. It's not one thing you want to go and do solo. So like not somebody who's, I wouldn't suggest somebody who just started and they're like, I get a bunch of good deals, let me go start a fund. No, don't do that. Please don't do that. Like, no, it is not for everybody. But if you get good deals, you're really good at flipping or building, and you're a very good operator. Like you trust your operations in no matter what the market is. Like you can sell in a bad market. Like, and this is like, I'm very vulnerable and honest. We got absolutely destroyed in these last 2 years trying to really flip, and started a fund, flip, and then like houses just sat. We took baths on some of them. We weren't as experienced on the flipping side. And so we tried to do too much too quickly, and it wasn't beneficial for us. And I'm very like honest and transparent about that. And so like, but I'm also very honest and transparent with my investors about that. And that's the most important part. And so, and then, so I would say like, you've got to have like a pretty good track record of being a good operator, regardless of the market. You get good deals, and you've got a great system in place. If you feel like you can scale that up, of course, everybody wants to raise private money, right? And so like my app, that's kind of one of the things that from your first flip to your final fund, that's kind of what we say, because it's the same person at different stages. Really, it just is who has the ability to raise more capital and the desire and the processes and systems to be able to scale it well. And so those are the type of people that become fund managers, are people that are like, okay, we're doing this well. We've managed through different market cycles. And I feel like bringing on more investor capital will help us to scale, and we can make and manage those expectations well with investors. And so we have a really, really unique ability to help people who are really used to like, hey, my 401k is getting 4% and getting destroyed by inflation, or like, hey, I'm invested in, the S&P 500 and really relying on the Mag 7 to give me good returns because the Mag 493, right? Like the other 493 are returning only like 4 to 5%. And so like the people who want to have access to alternative assets, I mean, we've got a really good opportunity to give people access to returns that they wouldn't normally have. Mm-hmm. So if you're a good operator, if you're you're good at what you do, you've managed through multiple cycles, or like you feel like, heck, you've managed through this past cycle, like these past 3 years, and you've been profitable, you're probably good enough. And so like, if you feel like you can take on investor capital and scale it, those are people who are good for launching real estate funds specifically. So that's what I would say. A lot long answer to your short question.
And so you're saying starting a fund is as easy as paying $6,500 to your website, and then that like does all the legal work for you. And then at that point, then you could talk to your relatives and Instagram followers about bringing them on. Is that kind of how it works?
Ooh, I love this question. So differentiators there, and I think I forgot to. So I coined this term microfund. Really, it's just a syndication. Okay, so like syndication, single asset fund. You can almost say that. So that's what it is.
It's for a specific deal. It's not just a general fund.
Correct. Right. So what we do in our platform is for micro funds, single asset funds. If you've got a self-storage unit, a multifamily unit, or anything like that you want to do, we can be able to do that and launch, like get you your fund docs, your micro fund docs in less than a week for $6,500. Now, if you want to do a larger fund, that typically will cost you like a blind pool fund. So you have syndications, which are single asset funds, and then you have blind pool funds, which are like multiple. Now, and then on the other side of that, you also have what's called fund of funds, but we don't have to get there. I don't know if that's y'all want to go way down there, because I'd love to, but we don't have to. So blind pool funds.
I'm down. I actually am kind of curious. So the fund is for raising, like normally you can get like 65% financing at least on deals, right? Or maybe 75% financing. Mm-hmm. But the fund is to raise money for the rest of the down payment, basically. Fantastic. For larger size deals, right? Yeah.
So like if you're doing a specific micro fund, then like it's going to give you a lot more preferred terms from a bank, because the bank is going to see, hey, this person actually has this much liquid right away. And it's going to give you actually preferred, honestly, preferred negotiations where you can say, hey, no, look, mister, I've already got this money. I don't have to rely too much on a bank because we've already raised this and we've got this liquid. Now, if you have a blind pool fund, that's going to be a little bit different where it's going to say, I invest in multifamily in the southeast of the United States or in Florida, Georgia, North Carolina, South Carolina. And so because that's your thesis, you typically have to stay within there. Now, you can allow it to go there, but let's just say we stay in there. And then now you are raising, 10, 15, $20 million for the acquisition of multiple properties in that thesis or in that area, because that's what you told your investors in your, private placement memorandum in a 110 page document. That like 60 pages of those is just risks and disclosures. But in that document, you state, this is where we're going to put the money. It's going to be in this area, and this is the purpose of it. And so then you can buy just about anything that fits that thesis in that area if you want to. And so that's going to be the difference. Single asset.
So for the micro fund, you have to find the deal first, and then for the other fund, you actually you can put the fund together and then go find the deal.
Yeah. A blind fund is a little bit more like, here's my track record, trust me. Right? So here's my track record. I'm going to do this. Trust me to be able to produce over and over. Here's the proof. Harder to raise capital for, because a lot of, especially then you hinted on this a little bit earlier, David, non-accredited investors, they want to see the deal. They want to go, hey, I've never really done this before, or I've done a couple of these, but it's based on, I want to see the exact location, the exact asset, how long is my money going to be in there? And then,
right.
And then even what is my expected return on that? A little bit tougher.
So can you raise money from non-accredited investors?
Oh, David, that's a great question. So without getting a little bit too in the weeds, there's two regulation filings, right? So you have, there's two exemptions to what's called a Reg D, Regulation D. You have a 506B and a 506C. So if you are a 506C, you cannot raise capital from non-accredited investors, but you can market your fund. And so this typically is going to be somebody who's I've raised capital before, I have a good track record, and I'm trying to scale it because they want to market their fund. And so they cannot allow non-accredited investors into their fund. Then you have a Reg D 506B. 506B is I always say, let's be friends. These are people that you have to have pre-existing relationships with, and you can allow 35 non-accredited investors into your fund. And now let's answer the question. What is accredited investor? And I always say an accredited investor is it's the 1, 2, 3s of an accredited investor. Either they have a $1 million net worth outside of their primary residence, or they make $200,000 individually for the past 2 years and for the foreseeable future, or $300,000 jointly with their spouse for the past two years and for the foreseeable future. That is what the 1, 2, 3s of an accreditation is. Now, the SEC in July.
Any of those, or it has to be a combination of 1 and 2 or 1 and 3?
Any of those. To go a step further, you also this is even a step further. If you own a company with $5 million in assets under management, so you own a company and it holds rentals, then you're of $5 million in value or more, then you're an accredited investor. And then another thing is if you have a Series 7, a Series 65, 66, then you're also accredited investor, because those are registered investment advisor tests. They also, the SEC did meet in July, and when they met, they are in the process of moving it to a test, because you can be 18, take a test and drive a car but if you don't have enough money, you can't be an accredited investor. So they're actually considering allowing it to be a test that you can do to be able to become an accredited investor now. But it's just not there yet.
Yeah. Did I see that one of the big internet gurus had been able to take money from more than 35? Grant Cardone, does he have a fund where people can invest even if they're not accredited?
This. Oh, David, this is good. So I'm trying to read your face, and I don't know if you know the answer and you're asking me this. So Grant has what's called a Reg CF. So that's a regulation. So you have Reg A. You have which is a mini IPO. So if you're planning on mini IPO your company, you do a Reg A. Reg CF is like a regulation crowdfunding that allows up to $15 million, or there's $15 million, there's $75 million. And it allows you to crowdfund. It's way more. It's like $100,000 to set up a Reg CF, but it allows you to take check sizes as little as like $500 from anybody, non-accredited investors, whatever.
What does the $100,000 go to? What is that? Is that legal fees or?
Yep. So even right now, let's say you wanted to start so 90% of funds in the world are Reg Ds, 506B or 506C. Your legal documents by themselves, just the legal documents, the cheapest I've seen is like $18,000. But the most I've seen is like $80,000 to $95,000 just for the legal documents, just to set it up. And so that
how is it not a template at this point?
So because I've tried this. Trust me, David. My very first fund, I was like, well, let me just get a template and let me chat GPT it. Duh. And so I tried that, and then it did not go as well as I thought it would. I ended up taking it to an attorney to get them to look at it, because like there's certain parts that I just was like, hey, how many units of shares should I have? How many of this should I have? And they were like, you really butchered this. Let me redo this for you. Now, the fee was.
I mean, I agree. It's a good thing that you have to spend money to start one of these. Yep. It's a good eliminating, scammers and people who shouldn't be responsible for funds. But I'm just curious what it goes to,
Yeah. The majority of it is going to be, a lot of it's going to be the time. And so this is what I teach. Like when we teach this, I always tell people the most expensive education teacher you'll ever have is an SEC attorney, because if you don't know how you want to structure your waterfall, how you want to do your distributions, what you want your thesis to be, how you want to form your filings, if you don't know that stuff, they will charge you for every single question and every single thing. And it becomes the most expensive teacher you'll ever have. And so when I do it, I try to go, hey, let me prep you on all the things they'll ask you if you want to go and do this on your own. They're going to ask you all of these things, and then you can go to the attorney with this stuff, and that will make it cheaper. But the thing that makes it really expensive is if you don't know how you want to do your distributions, or you're like, hey, what do you think, attorney? That stuff makes it really expensive. They're going to work from a template. You decide on how much money you want to spend by how much information you have going into that meeting for the most part. And so, or into that, that launch. What people also do wrong too, and this is where, when we teach, I teach just a different blueprint for this. Where people go wrong is they try to go, let me get my docs first, and then from there, then I'm going to go ahead and start launching my fund and start raising capital. But you don't have, you don't have, you don't even know investors are going to be interested in what that is. So what I always talk about is I always say design it. What's your edge? Who's on your team? What's the thesis? And then go and start thinking through how you're going to build it. How do I want to do the distributions? If we're going to do the distributions, how do we do that? How do investors get paid? All that stuff. And then from there, then I start going and getting soft commits. It's totally fine to get soft commits from family and friends, initial contacts, things like that. You're not going and marketing it. You're just saying, hey, I'm thinking about raising a fund for this, or I'm thinking about investing in this. Would you be interested in it? And you're getting soft commits. But now you have, and David, you guys are familiar with this, product market fit, right? Now I know that my fund is something people would be interested in investing in. Then you go do the legal docs. People spend a lot of money when they go to do their legal docs first, because they think they're oh, I'm violating rules if I don't have it formed yet. And then they go and they're shoot, people aren't actually interested in this. Let me go back and change some stuff. And then now the attorney has to change some stuff. It costs you a lot more money. So a lot of it comes down to the order in which you do it in as well.
Dang, that makes a lot of sense. Sometimes I've heard that you could just talk about a deal that you're doing and not even ask. But the more you kind of share, then the person might, show interest and ask some questions, right? And that could tell you if they're interested. And they might even ask themselves, which is the perfect scenario because they're coming to you, right?
Yeah, that's exactly right. And when I talk about, hey, this is how you can go and raise capital, a lot of times it comes down to what's your elevator pitch? So when I started raising capital for my first fund, I stopped telling people, they go, oh, what do you do? And I go, oh, we fix and flip properties. We do this. I go, I help people make double-digit returns by passively investing into deeply discounted real estate. And then people go, oh, that's cool. Or they go, oh, tell me more. And those are my people. And so a lot of things that I would tell people is interesting or interested people are interesting. And so what I want to do is I want to make sure that I am interested in people. I want to make sure that they feel valued by me. And so when I first started raising, I would rekindle like old relationships, not by going, "Hey, I'm investing into real estate. I think it's something you'd be interested in. Would you want to hear talk about it?" It would be like, "Hey, I noticed you and your family went to Disney World. I'm thinking about taking the family this week. Like, what are some tips that you have?" And so then I'm re-engaging with them. I'm having a conversation with them, and then I go, "What are you up to now, man? Like, how's life treating you?" And they ask me, and then like because I'm interested in them, then they become interested in me. I become more interesting. And so then I go, "Oh, this is what I do. I help people to invest into deeply discounted real estate and make double-digit returns." And then they go, "You know what? I've been thinking about investing into real estate, but didn't know where to start." Or like this, or that. And then I'm like, "Oh, well, let's get together. Let's chat about it." And so really curiosity, I say like selling out of curiosity, not out of like, not out of, what's the word? Like selling out of curiosity, not out of like me being like, "Hey, like commission breath. Like, give me a deal. So, yeah. So that's where I think that changes the game where, like you said, people start becoming interested because like one, I'm posting about it. Sorry, I don't mean to go on like this long thing, but one of the other things that I do is like people end up investing in my why more than my what a lot of times. If I'm talking about, hey, these are the lives that we're impacting by flipping these properties, people want to be a part of that. I'll get on the phone and I'll be like, "Hey, your money's going to make money." Like that's the easy part, but your money's also going to make an impact in the world. And people who have reached a certain level in their life, that's what they're more concerned with rather than making more money. And so then I'm like, "Hey, this is the impact we're making." And people want to be a part of that. They want to be a part of something bigger than themselves. And they love that their money is making a bigger impact while they're also making money. Yeah. And so I share our why a lot on social media of like, this is what I'm doing. This is look at this house that we walked through. These are the families we're affecting. And people are like, "How do I become a part of that?" And that's a good way to help too.
100%. I get it. I'm curious though, at the beginning, you said you're kind of done with rental properties. So is your fund actually buying things that people are renting?
No. So I actually, so that fund I'm winding down. So, wound down the real estate fund, mostly because
I wind down a fund. You just sell it off and then, give everybody their money.
Yep, exactly. Pretty much. In a fund like ours is more of like a fix and flip rental holding fund. And so people gave money. So you typically have what's called like cash events. If you have like a single, like a micro fund, then the cash event is either refinancing that asset or selling that asset. And then what happens is all the money from that one event then gets distributed pro rata, according to your waterfall, like blah, 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 big words, gets distributed to your investors and then to you. They typically have a preferred return. They get paid before you do. And then, but in a fund like mine, where it was almost like a evergreen fund where we had perpetual deals, we were paying either monthly or quarterly distributions on the profits and then splitting those profits pro rata. And then at the end, right, as we're like, "Hey, fund is winding down December 2025, then we pay all the capital back at that point." So, yeah.
Got it. So, but the new funds they're now just for like flipping properties, or are you just working on helping other people do funds?
Yep. So now I just work on helping other people do funds. Now I am starting a Bitcoin treasury because I'm super bullish on Bitcoin. So I am in the process of launching. It's interesting because that's actually like a C Corp, but we have a fund that raises capital and to invest into that C Corp. But anyways, so yes, currently all I do now is like we help people to launch funds. So if there's a guy in Seattle and he does a lot of flips. So he wants to do something very similar. But then you'll have some people who want to buy multifamily units. And so they'll start a fund. And then you have what's called the third one is what's called a fund of funds. This is for people who are like, "I've got really rich friends and I'm good at finding deals. But I'm not an operator. I'm good at finding deals. I've got rich friends. All my doctor friends, why don't you guys give me money? I'll give you 8%. And then I'm going to go find us really good deals to invest in." And then they take it and they're a fund that invests into other funds. And then what happens is that person that's a good deal finder and has good friends, they'll say, "Hey, other fund, because I'm coming in with more money, give me 12%. And then what happens is when that 12% comes in, they keep 4 and then they pay their friends out 8. And so then they're making management fees and the excess in returns. So really there's like so we help a lot of people start fund of funds because they have friends and then they know how to find good operators. Sorry, y'all. That's a lot. Brian, I'm sorry, man. I feel like it's like, what did we get? I feel like you're like, what did we get ourselves into?
No, it was great.
It is great.
No, I really did love asking and learning about the funds, man. And so congrats on your software and realizing that that's kind of what you're passionate about. You could tell you're passionate, right? Just by how much you're talking about it. So
yeah.
Thank you for that.
It is. So like, sorry, really quickly. I love funds. I think funds are they are the most lucrative business model in the world because you have the ability to scale infinitely. I think, and please, anybody listening to this, do not take offense. I think the hierarchy in real estate goes realtors, and then it goes like wholesalers, and then it goes, and then it goes flippers. Yeah. That's right. And then it goes flippers, and then developers, and then it goes like lenders, right? So like hard money lenders. Then it goes the bank, and then it goes funds, because funds are the ones that actually fund the bank. Funds like BlackRock, funds like we know about BlackRock, but those aren't the only ones, because even like, I'm sure everybody knows of like Amherst, Progress Residential, all of those. I mean, they're getting their money from BlackRock, by the way. Mm-hmm. But these funds, what happens is these people they make like management fees off of the ability to raise more capital and deploy that capital for profit. For instance, David Tepper, who is the owner of the Panthers here in Charlotte, North Carolina, he bought the Carolina Panthers and Charlotte FC for $2.8 billion in 2018. Last year alone, David Tepper's take home, like not his net worth, take home was $3.2 billion. So David Tepper is one of the like wealthiest people in the world, but also one of the most successful fund managers. You've also got Ken Griffin. He took home $4 billion. He manages Citadel fund, and I mean $1 billion a quarter is what he takes home. And so you have the unique ability to be able to raise capital, and if you can deploy that capital and make profit, then it scale. You're like what you make and how your company does scales proportionately to the amount of capital that you can raise, and so it becomes one of the most lucrative business models in the world. It's kind of crazy.
Wow. I thought Citadel had 60 billion under management. You're saying he takes $1 billion every quarter as his pay?
So
and
like
only have 60 under management.
So what he does is, it doesn't matter how much he has under management. It's the profit that comes in. So for instance, we're really getting into this, David. So Citadel, what they're going to do is they're going to take a 2% management fee right off the top, right? Money comes in, 2% is the management fee. So 2% of 60 billion is, gosh, I don't know, 120 million, right? So like 2% of 60 billion is 120 million. And so from there, 120 million right off the top goes to his team, goes to like whatever, to their company for operations. What happens is the next 8%, depending on, they're probably giving 8. So I mean, like they've got the like New Jersey pension fund and like these massive pension fund and like they invest into a company like Citadel, and then Citadel invests into other things. So they're, I mean, really that's safe investments. So they're probably only returning like 6 to 7%. They're not like anything crazy. They are safe 6 to 7%. And so then after that 6 to 7%, the profits, so the profits that are created are then split. And I'm pretty sure in Citadel's case, which is kind of crazy, it's typically 80-20, right? We see what's called like a 2 and 20 model. I think Citadel's like 60-40. I know that Bridgewater is like 60-40, and they haven't accepted money in the last like 10 million, and their smallest check size is like 5 billion. It's crazy. So, but like Citadel, I think they're at 60-40. So just imagine 40% of all the profits that are then made are given to Citadel, and 60% is distributed back to like their investors. So that's where that billions on, and I think he's returning, like, I think his historical was like 24 or 25%. That's crazy. Imagine an additional, right? So for instance, if you go 2% for the management fees, 6 to 7% on the pref, and then so now we're at 9%. So the next 19% is split 60-40. That's crazy on $60 billion. And so that's where that profit, and that profit goes straight to Ken Griffin. Yeah. So,
no, that's awesome. Appreciate the breakdown, man. It's super interesting.
It's crazy.
As we're kind of winding down, where can people go to find you on social media? At Devin Robinson 1 on Instagram, I see here. Yeah, that's right. And anywhere else you'd like to send them or things you'd like to say? Yeah.
I mean, if they're interested in launching a fund, we have, wearefundfounders.com. dealmachine.com/apply. And then FundFlow OS is the software. Those are like the big things right now. That's all I do. So happy to do that in any way. And of course, like we'll give, you just let them know we sent you and I'll figure out something to give your people. That'd be amazing. And then you.
Thanks, Devin.
That'd be great. No,
yeah,
thank you.
absolutely. Really appreciate it. And I'm super excited about where you're headed. And I could feel your energy and it's great to be around. I appreciate it very much.
Oh, thank you, man. I appreciate you.
And congrats on the new home.
Thanks, man. Thanks. We're thankful.
Thanks for listening to the Deal Machine Real Estate Investing Podcast. Please leave us a review and follow along wherever you're listening to your podcast.